Hello, ladies and gentlemen, Greg Michalowski from ForexLive.com. This is a technical look at the euro versus US dollar. Best laid plans were that I would be able to do a number of these analysis into the new year, but a cold that turned into COVID had slowed me down quite a bit. And so just getting to starting to look at some of the bigger picture charts and ideas for some of our currency pairs. I'm going to start by taking a look at the euro versus US dollar. And to switch things up from what I typically do when I take a look at the charts from a technical perspective, I want to give a little perspective of what we just went through and what we may look forward to going forward in respect to things like the ranges that we saw in trading for the euro versus US dollar last year and in the past. And when we take a look at the low to high trading range for the euro versus US dollar, we did 1,959 pips. That's 19 big figures and 59 1/100ths of another big figure in the euro versus US dollar from the high to the low. And that's a pretty decent range. In fact, it was the highest range going back to 2011. Over the last 3 years, the average has only been around 1,600 pips. The last 10 years, the average has been 1,453 pips. So it was at the extreme of what is a normal trading range, at least over the last 12 or so trading years, which is our history. Now, admittedly, there have been other times where the price has gotten above the, let's say, 2000 level right through here. But if you look going back to, let's say, 1993 through here, there have been 1, 2, 3, 4, 5, 6, 7, 8 years when the price traded above the 2,000 pips for the year. Those are like the extremes. Okay, those are the years where something extraordinary happened. During these years right through here, that was the recession, where the housing market tumbled, so on and so forth, and we saw big, huge trading ranges in the dollar and the euro versus US dollar in particular. But those can be the exception rather than the norm. We did have we do have recessionary feelings out there, but most people think that if we do go into a recession, let's say in the U.S. or maybe even Europe as well, that the recession will be fairly shallow. It won't be as we aren't in those situations like we were in 2008 with the housing crisis, banking crisis, so on and so forth that went along with it. That story may change. I'm not guaranteeing anything here, but we might expect somewhat more narrow. So this last year was toward the upper end of what is normal. And what we might expect in 2023 is something less than that, okay? So is the normal going to be 1,600 pips? Maybe. Is the normal going to be 1,450 pips, a 10-year average? Maybe. Let's say that is what we're going to see, somewhere between 1,400 and 1,600 pips for 2023. So how does that fit in to from a technical perspective and even from a fundamental perspective as well? And Adam pointed out in his video with BNN, or his interview with BNN this weekend, that he sort of expects 2023 to be a year where they sell the euro. You sell rallies in the euro. They have budgetary issues. They still have Russia-Ukraine. They still have the oil and the reliance on oil issues that they have to work through, and longer-term ideas as far as alternative means of energy. What are they going to do there? All these, they have a central bank that's being a little bit more hawkish now, all of a sudden, and so they may tighten conditions that may force or push the euro to the upside initially, and then we ultimately see selling the rally, though, in the euro versus US dollars. They end up slowing down their economies, having higher budget constraints, so on and so forth, and that leads to sell the rally in the euro versus US dollar. So let's take that fundamental view: sell the rally in the euro versus US dollar. Let's take the fundamental view of that we're going to have a range of 1,400 to 1,600 pips. So now we start to look at the technicals and see where all that fits in. So if we're looking for, let's say, 1,500 pips in the euro versus US dollar, where might we look to sell the euro versus US dollar on further upside momentum? After all, markets will still have a certain momentum, and we're heading into the new year with more of an upside momentum here for this pair. So if we continue to see a strength in the euro dollar on the back of, again, the ECB, whatever was happening over the last few months, where we had a weaker dollar, stronger euro, we could see the price move up toward this 50% retracement level. That 50% retracement level is of this move down from this high right here, which is the beginning of 2021, to the low that we saw in 2022. The 50% retracement level comes in at 1.0942. Now, if we understand that over time, the price is going to move up toward that level, or has the potential to move toward that level, we also may run into this declining 100-week moving average. That 100-week moving average currently comes in at 1.1119. But as you can see, over time, I kind of put a dashed line here at the slope of that line. Over time, that moving average is going to work its way to the downside, right? And we can imagine that around this point right here, which if you look at the year, and this from this point to this point is a year, it sort of looks like maybe 2 months into the first quarter, the 100-week moving average is going to be right near the 50% retracement level. So if we do see some sort of rotation to the upside in the early part of the year, a continuation of the trend to the upside, we're going to run into that declining 100-week moving average and the 50% retracement of the move down from the 2021 high to the 2022 low. So for me, I'm going to be looking for that area to be a ceiling, a tough ceiling to get to and through. Now, it might be that the fundamentals change, the story changes, and we go racing through that level, but anticipate that this level, right near the 109.42 level, is going to be a level of significance in 2023. All right, for 2 reasons. 1, the 100-week moving average. 2, the 50% retracement level. Technical levels, fundamental reasons to expect resistance against that level. That's what we can target. That's where we might see sellers come in, or for you to take an idea that maybe this is an opportunity to try to sell the market. What is the risk of that at that level? Well, the risk is if the market moves above that level. So if we start to trade 109.75 or something like that, get out, okay? It's not working. We would be above the 100-week moving average. We would be above the 50% retracement level. The story's changed. That story can be anything. We don't know, but we have the technical levels to define our risk, limit our risk, understand what our risks are, and try to fit the story in. So that level is going to be my key level for the euro versus US dollar. So let's say that's the high for the year. By simple mathematics, if the high is going to be around the 109.50 level, if we take 1,400 pips or thereabouts off of that, or 1,600 to 1,400 pips off of that level, well, we're down at 93 for a low. So we would break below the low for 2022, or on a 1,600 pip move to the downside, or if it's 1,400 pips, we'd be right around the lows for the year. So we'd expect to see something like, so if we were to see this move to the upside, we see something like that, and all the way back down to the low right here. We retrace the entire move to the downside. Is that possible? I don't know. We'll see. I mean, but these are the sort of things that we have to sort of fit into the story. What we know is that the 100-week moving average 50% retracement is going to be a key level. If we go above that level, then we just increase, and we still think the selling is going to be in play. Then we start to look toward other levels above that might come into play, that where we might look to sell against the level. Maybe it's a 200-week moving average. This line is going to be moving down here. Maybe it's that, and we start to see a seller down here and see a rotation to the downside. We don't know how it's going to play out, but we do know technically those levels will be key on the top side, and we'll see how it all plays out. So if we were to go lower, off of the 50%, off of the 100-week moving average, we'd have other clues on the downside that we'd have to look toward in order to give us that confidence that the sellers are remaining in control. And the first one is this level right here. This level represented the low price going back to 2020. It comes in right around the 38.2% retracement. 106.34.7 is this low right here. The 38.2% retracement of this move to the downside is right here at 106.100. So getting below that level is going to be a key level on the downside. If we get and stay below that level, may happen the first week of the year, then we're going to see further selling to the downside here, or another test of what is going to be another key area, and that is right here between here. And this corresponds to these lows right through here, where the market found a nice little bottom through here, tried to hold the bottom right here, failed, and then reestablished support out here before moving to the upside. This is going back to 2014, 2016, but the market's going to remember that area just like it remembered it here, just like it remembered it right through here, and like it remembered it here, and then moved up through here. So this area between the 104.61 and 105.18 level is going to be another key level on the downside, and then we're going to start to look at this level between 103, looks like 53 up to 103.78, 103.67. Those levels are going to be in play as well, and give us ideas as far as a downside potential, downside momentum for this currency pair as a result of those levels through here. So, the story is, if we're going to have 1,400 to 1,600 pips, look for this area right here to hold resistance. If we're selling the rallies, 100-week moving average, 50% retracement. On the downside, we want to see the price move below the 38.2% retracement. We want to see the price move below this level and this area through here. And if we do that, then it opens up the door for the potential to move down toward that levels. If the market is not able to get through those levels, maybe the story is going to be different. Maybe the story is going to be a move back above the 100-week moving average, above the 200-week moving average, and we see further move to the upside. We'll see how it all plays out. But what is important for us as traders is to have an idea as far as where the limits are, where we may be going, what targets we need to get through, and we'll see how it all plays out. My name is Greg Michalowski. Good fortune to trading. Bye-bye now.